Imagine that you have $50 million just sitting in an account.
Must be nice.
Right, yeah, just 50 million waiting to be deployed into some major crypto project. You essentially have two doors to choose from.
Okay.
Door number one, you take that 50 million and you just buy the project's native token on the open market, like anyone else would.
The standard retail play.
But then there's door number two, where you buy a piece of the actual corporate entity, the company that issues the token.
Which is a completely different ballgame.
Because for the vast majority of retail investors, you and me, door number one is the only option. But for institutional players with deep pockets, the entire structural risk is handled differently.
It represents two completely separate universes of risk, and really understanding the mechanics behind that divide tells us so much about where the market is heading right now.
Yeah, and that's exactly what we're getting into for this deep dive. We're pulling from this massive stack of market data, network activity reports, private investment briefs to really unpack this divergence. And just to set the scene for you, it is mid-August 2026. The landmark Clarity Act hasn't passed recently, which, for those catching up, that's the legislation that finally gave the crypto industry a defined legal framework. It basically categorized different digital assets and opened the floodgates for all these spot ETFs.
Right.
And right now, XRP is trading around $1, but when you actually look under the hood at the underlying data, there's this gaping canyon.
A huge disconnect.
Between the immense corporate success of Ripple, the company, and the fundamental on-chain reality of the XRP token itself. So our mission today is to figure out exactly why Ripple's preferred equity investors are practically bulletproof, while direct XRP token holders are, bearing almost all of the downside risk.
Yeah, and I think the best place to start that analysis is by rewinding slightly, right? Let's go back to November 2025.
Okay, the big funding round.
Right. Ripple Labs raised $500 million at a $40 billion valuation. And honestly, that valuation number, that is the anchor for everything we're going to talk about today.
Let's actually dig into that number for a second, because when those institutional investors were, evaluating Ripple to arrive at $40 billion, they estimated that roughly 90% of the company's net asset value was just the market value of its XRP pile.
Yeah, 90%.
Which is wild. At the time, they held about 37 billion XRP, right? Mostly locked in escrow and operational wallets. So as an investor, you're essentially looking at this software company that's also acting as a giant vault.
A vault holding a highly volatile digital asset.
Exactly. Now, if those investors had just gone and bought $50 million worth of XRP tokens,
like retail does.
Yeah, then any drop in the token's market price would wipe out their investment dollar for dollar, direct exposure. But instead, they bought preferred shares in Ripple Labs.
All right. And those two words, preferred shares, they create this structural armor that just completely changes the calculus.
Let me actually test an analogy on you to see if I'm conceptualizing this right.
Sure, go for it.
So say you're buying a house, but 90% of the home's appraised value is tied to this abstract, incredibly volatile art collection that's just sitting in the living room.
Okay, I like that.
If that art collection suddenly crashes in value, the overall value of the property plummets, right? So why on earth would sophisticated investors write a $50 million check knowing the vault is filled with something that swings wildly in price unless, there's some hidden safety net?
Well, there is. The safety net you're looking for is called a liquidation preference.
Okay.
It's pretty standard in corporate finance.
Okay.
But how it's applied here is fascinating because it contractually separates the investor from the token volatility entirely.
How does that work in practice?
So in any sale of the company, bankruptcy, formal liquidation, whatever, preferred shareholders have a contractual right to get their original investment back first, before anyone else.
Wait, before the founders?
Oh, yeah. Founders don't see a dime. Employees don't get their payouts. Early common shareholders get absolutely nothing until that preferred claim is fully paid off.
So they're standing at the absolute front of the line.
Exactly.
But let me push back on that for a sec, Lou. If the token crashes, if the art collection becomes worthless, doesn't that liquidation preference become kind of worthless too? Like if the vault is empty, being first in line to an empty vault doesn't actually help you.
Right, but that assumes the token is the only asset with residual value, which it isn't. Even if the value of that XRP pile completely tanks and Ripple's total valuation drops from $40 billion down to, say, $5 billion, those preferred investors only need to extract their initial $500 million.
Oh, wow.
And Ripple has massive cash reserves, they've got super valuable intellectual property, and incredibly lucrative operating revenues from their RLUSD stablecoin business.
So they have plenty of other assets to pay them out.
Exactly. The investors don't care if the house's total value dropped, because as long as the entire estate can be sold for literally anything that covers their initial check, they are made whole. The common shareholders are the ones who absorb all those losses.
Okay, so that's the first layer of protection. But reading through these investment briefs, there's a second mechanism that drastically alters the power dynamic here.
A good option.
Yes, they didn't just negotiate getting their money back in a worst-case scenario. They engineered this contractual put option.
Yeah, the put option or the sellback right, this is where the divide between a token holder and an equity investor becomes just glaringly obvious.
Because they can force a sale, right?
Exactly. Under the terms of the deal, these investors hold the right to force Ripple to buy their shares back after a holding period of 3 to 4 years. And they're not just buying them back at cost either.
No, the contract stipulates a guaranteed 10% annualized return, which is insane.
It's massive.
And it gets more aggressive, right? If Ripple initiates the buyback early, it triggers a penalty rate, like a 25% annualized return.
Yep, the terms are ironclad.
Let's actually run the math on just the baseline 10% to see the actual financial burden here. You put in $50 million at that $40 billion valuation. Fast forward 4 years.
Okay.
10% compounding annually over 4 years means Ripple is legally obligated to hand you roughly $73.2 million.
Yeah, checks out.
So my question is, how does a contract force a company to pay out $73 million if their primary treasury asset, the XRP, has tanked by 70% over that same window?
Well, the short answer is the contract does not care about the token price at all. Really. Ripple is obligated to meet that liability using whatever means necessary. They can use their cash reserves, they can use the operating profits generated by RLUSD, or, crucially, they can sell off their remaining XRP on the open market to raise the fiat they need to pay those investors.
So they basically engineered a loophole. They converted a highly volatile crypto narrative into a highly structured corporate credit instrument.
That's a perfect way to put it.
They capture all of the upside. Like, if Ripple goes public in an IPO, those shares convert and they make a fortune.
Yeah.
But they have this mathematical floor on the downside.
Exactly. The decision matrix for the institutional investor here is incredibly straightforward. After 4 years, they just evaluate the implied value of their equity.
And if it hasn't grown enough?
If Ripple's growth hasn't naturally outpaced that 10% compounding floor, they just pull the ripcord. They exercise the put option, take their $73 million, and exit. They are 100% insulated from the daily open market volatility of the token.
Which naturally begs the question, right? If the institutional money is structurally hiding from the volatility of the token, what are they so afraid of?
Yeah, that's the multi-billion-dollar question.
The sources point heavily to this idea of an evaporating utility floor for XRP itself.
Right. To understand the token's vulnerability, we really have to look at what historically supported its valuation model.
Okay, lay it out for us.
Well, the market price of XRP sitting around $1 in this post-Clarity Act environment, it has almost zero fundamental support from actual organic usage.
Really? Almost zero?
Basically, yeah. The price action right now is driven by speculation, structural ETF flows, and just lingering narrative momentum.
But the primary narrative for years was on-demand liquidity, ODL.
Right, the cross-border payments thesis.
Yeah, this concept that XRP serves as the ultimate bridge asset for international finance, like the digital oil of the system.
Right.
But the network activity reports show that this specific use case generates barely any persistent demand.
Not at all, practically.
The transaction fees on the ledger are a fraction of a single drop of XRP. And beyond the fees, there is this mechanical issue of velocity, right?
Oh, velocity is the critical metric here. It completely unravels the utility valuation.
Explain that for us.
So in monetary economics, velocity measures how frequently a single unit of currency changes hands in a given time frame. In the ODL model, a financial institution uses fiat to buy XRP, They transfer it across the globe in seconds, and the receiving institution immediately sells it back into a different fiat currency.
So it's instantly flipped. I always use an analogy to picture this mechanism. If a token has extreme velocity, it's like a single taxi cab that has the ability to teleport.
Right, teleporting taxis.
If you own a teleporting taxi, you only need one single vehicle to service millions of people in a major city. It drops a passenger off and instantly teleports to pick up the next one.
You don't need a whole fleet.
Exactly. Because of that efficiency, there's zero demand to build a fleet of 1 million taxis. If XRP is the digital oil for payments, it is oil that never actually burns up. It just gets reused infinitely.
That analogy gets right to the core of the problem. And honestly, the math makes it even starker.
What does the math show?
Analysts have modeled out these highly optimistic scenarios, featuring multi-hundred billion-dollar annual payment volumes flowing through that ODL system.
Okay.
But because the tokens aren't held as a store of value, because they're instantly flipped, like your teleporting taxi, those massive transactional volumes only require a tiny circulating supply to function.
So they don't need to hoard it.
Exactly. Models show that even at peak global adoption, the necessary utility would only support a fundamental token price in the low cents.
Wow. So the actual utility of moving the money dictates the price of pennies, not a dollar.
Yep.
And that's assuming institutions even want to use a volatile bridge asset in the first place. Because the data indicates Ripple's own stablecoin, RLUSD, is increasingly handling the actual settlement work now.
But think about it from the bank's perspective. Why would a multinational bank take on the slippage risk of volatile token, even for a few seconds, when they could just settle the transaction using a dollar-pegged stablecoin?
They wouldn't.
No. RLUSD is actively cannibalizing XRP's primary historical use case. Without institutions needing to buy and hold XRP to conduct their daily business, there's no persistent structural bid in the open market to absorb the massive available supply.
So if institutions aren't buying it to move money, and the velocity is too high to create any kind of scarcity, what is the XRP ledger actually doing all day?
Good question.
Our sources broke down the top 5 non-transactional holders on the XRPL right now, and these represent roughly $4 billion in value. But looking at this list, the network operates more like a static compliance registry than some flowing financial superhighway.
Yeah, let's examine the on-chain data to see how that registry actually functions. As of August 2026, the single largest representation of value on the XRPL is a project called Just Token Energy.
Okay, Just Token.
They hold roughly $2.2 billion in value on the ledger, which is over 50% of the non-transactional share.
The ticker for that is JMWH, right? It's tokenized energy. Each digital token represents 1 megawatt hour of contracted energy output.
Exactly. Then you have CRX tokenized credit, sitting at over $1 billion. Those are private, asset-backed credit products.
Right.
The third largest is VERT, private credit, at $438 million. Managing Brazilian agribusiness and receivables. And then you've got AD Collection tokenizing Dubai diamonds and Mercado Bitcoin handling more private credit.
Wait. Let me make sure I'm understanding the mechanics of this. We have tokenized Dubai diamonds, Brazilian agriculture, and megawatt-hour energy contracts just sitting on the ledger.
Right.
They're storing billions of dollars of value. Doesn't that create massive demand for the XRP token itself? I mean, they're using the network.
It creates demand for the ledger's security, but not for the token. That is a crucial distinction. Take Just Token Energy. To manage $2 billion worth of energy contracts on the XRPL, they do not need to go to the open market and buy $2 billion worth of XRP.
They don't.
No. They only need a microscopic fraction of a penny in XRP to pay the ledger's timestamp fee every time they record a transfer of ownership.
Oh, wow. So they just pay the gas fee, basically.
Exactly. They are using the blockchain as a highly regulated storage unit to record who owns what. It's a brilliant technological use case for a registry, don't get me wrong, but it completely divorces the billions of dollars of economic activity happening on the ledger from the price of the native token.
So the registry use case makes sense, but the sources also detail a major complication regarding secondary utility, specifically with the Flare network.
Oh, right. The collateral issue.
Yeah, because the long-term thesis was that Flare would provide a smart contract layer, allowing users to lock up their XRP as collateral to take out loans in RLUSD. But there's this new protocol update called the FIP10 three-strikes rule that seems to be breaking that entire model.
Right. The FIP10 rule introduces a really severe technical bottleneck. So for a collateral network to function safely, It needs perfectly accurate real-time price data,
That's
right?
usually provided by validators running data oracles.
Exactly. Well, FIP 10 dictates that if a validator fails to provide precise data from regulated sources, 3 times 3 strikes,
Yeah.
they are penalized or completely removed.
Which is strict.
Extremely. So to guarantee they don't fail, validators are being forced to implement what are called trusted execution environments, or TEEs.
I know a bit about Ts. They're highly secure enclaves within a computer processor, right?
Right.
Designed so that not even the owner of the machine can tamper with the data being processed inside.
Right.
But why does forcing validators to use them break the collateral model?
Because T hardware is incredibly expensive and complex to maintain. Think about it, if you're a validator, you are already making very slim profit margins validating transactions. Suddenly, the network mandates that U.S. purchase and maintain thousands of dollars in specialized enterprise-grade hardware just to participate. These architectural changes introduce unpredictable hardware costs and serious governance risks. The profit margins just vanish. So validators drop out, the network becomes less robust, and ultimately, trying to use XRP as collateral for RLUSD loans becomes technically cumbersome and fundamentally risky. The friction is just way too high.
So we have a token with a vanishing utility floor, actively cannibalized by its own corporate stablecoin, running on a network functioning as a static filing cabinet, while secondary collateral networks are basically choking on hardware costs.
That's a perfect storm.
Which leads us to the final consequence of this entire structure. If the institutional equity investors are safe behind their put options, who is absorbing all of this downward pressure?
Retail.
This brings us to the ETF mirage and the mechanical cost to the retail investor.
Yeah, the Clarity Act's most visible immediate impact was obviously the approval of spot XRP ETFs. And during the initial launch, the hype phase, we saw hundreds of millions of dollars in net inflows per month.
But looking at the data from mid-2026, those flows have practically flatlined. We're seeing low single-digit millions and frequent days with net zero or even negative flows. How does that mechanically impact the price of the token?
Well, an ETF is not a static pool of money. It relies on a dynamic arbitrage mechanism managed by entities called authorized participants, or AP. So when retail investors lose interest and sell their ETF shares, the market price of the ETF temporarily dips below the actual value of the underlying XRP it represents.
And those authorized participants step in to close that gap.
Exactly. The AP step in, they buy the discounted ETF shares, dissolve them, and take possession of the actual underlying XRP.
And then what?
They immediately dump that XRP onto the open crypto exchanges to pocket the risk-free difference. So when the ETF is seeing massive outflows, this arbitrage mechanism creates an aggressive doom loop of mechanical selling pressure on the underlying asset.
And they're dumping those tokens into a market with zero organic utility demand.
None.
Plus, and this is huge, Ripple is still conducting its monthly escrow releases, right? They're unlocking and releasing hundreds of millions of new XRP into circulation every month.
Yeah, diluting the supply even further.
You combine ETF redemptions, mechanically dumping tokens, with Ripple's escrow diluting the supply, and absolutely no persistent bid from institutions to buy them up, the asset just loses its independence. The reports describe it as becoming a pure high beta asset.
Yeah, and high beta simply means the asset's price movements are exaggerated reactions to the broader market, rather than trading on its own fundamentals.
Like tracking Bitcoin.
Exactly. If Bitcoin moves up 5%, a high beta asset might swing up 10% on pure algorithmic sympathy. But if the broader market dips, it crashes way harder. It becomes entirely unmoored from the ledger's actual economic activity, dependent strictly on residual narratives and macro market cycles.
Just think about the position of a retail investor in this scenario. If someone is holding the token directly because they believe in the long-term, digital oil utility story, they are functionally acting as a shock absorber for the entire ecosystem.
That's exactly what they are.
They absorb the mechanical downward pressure from the AP's dumping ETF redemptions. They absorb the inflation from Ripple's escrow releases. All while the preferred equity investors we discussed at the very beginning are sitting safely behind their contractual armor, locked into a guaranteed 10 to 25% return.
It perfectly illustrates the structural divergence we set out to analyze today. Because the corporate entity Ripple is positioned to thrive.
Oh, absolutely.
They can expand the RLUSD stablecoin, execute strategic acquisitions, generate substantial operating revenues, and watch their private corporate valuations skyrocket. Meanwhile, The token market shifts from an active utility thesis to just a purely speculative vehicle,
The direct holders bear the unfiltered brunt of the token's stagnation.
entirely disconnected from the company's financial triumphs.
It is honestly a masterclass in institutional risk management and a pretty stark reality check for the retail market.
Definitely.
I mean, we started by asking how you would deploy $50 million. The institutional money looked at the landscape and realized that holding an asset that can theoretically go to zero is just a completely unnecessary risk. They didn't buy the technology, they bought a senior contractual claim against the company building the technology.
And when you have the leverage to demand a mathematical floor, you take it. You let the open market absorb the volatility of the token while you capture all the corporate upside.
It makes complete sense from their perspective, and that actually leaves us with a pretty provocative concept to consider as we wrap up this deep dive. If institutional investors can legally structure a deal that forces a crypto company to use its stablecoin profits to guarantee their private equity returns, it forces us to question the entire life cycle of these assets.
Are we witnessing the end of the utility token era?
Consider the possibility that the ultimate legacy of crypto tokens wasn't to revolutionize the mechanics of global finance. What if, in the end, they simply served as a highly volatile, high-risk crowdfunding mechanism utilized to bootstrap what is ultimately just traditional, highly regulated corporate finance?
It really changes how you view that volatile art collection in the living room entirely.
Thanks for tuning us for this deep dive.